Welcome back to the Deep Dive. Today, we're exploring some really important insights. We've got the month that it was, August 2025 report from the Macro Butler. This deep dive is all about cutting through the noise, getting you the critical knowledge you need on the economy as we, well, head the back half of the year. Our mission is to distill the core findings from this report, give you a shortcut to understand the big picture and, what these trends actually mean for you.
Yeah, this Macro Butler report is, I think, particularly insightful. It really digs past the headlines, often challenges the common perceptions out there. We'll try and connect the dots, give some crucial context on what's driving these trends, and importantly, why they should matter for your financial outlook.
Exactly.
Yeah.
We're going to cover quite a bit. The labor market, consumer spending, this mounting debt pressure, and even these big shifts in global financial power. It's a lot, definitely, but we'll make it an illuminating, hopefully engaging conversation. Okay, let's dive right in. The U.S. labor market, often seen as like the main indicator of economic health, right? The official story can sometimes sound pretty optimistic, but this report for August 2025, it suggests something a bit different, more nuanced.
It certainly does. Yeah, despite maybe some official optimism, the July non-farm payrolls were actually a big disappointment. Seasonally adjusted jobs, they rose by only 73,000. That was way below what people were expecting. But here's where it gets really telling. May and June, they actually saw an additional 258,000 jobs cut through revisions.
Whoa, wait. 258,000 cut.
Cut, yeah. June's initial number, they said it was a gain of 147,000. That got slashed down to just 14,000.
That's a massive revision. So the picture was already much weaker than we thought, even before July's numbers came in.
Precisely, much weaker. And even government hiring, which, had been a key support,
Right.
It only added 11,000 jobs in June. Not the 70,000 they first reported. Private payrolls, up just 83,000, and almost all of that was healthcare. Manufacturing professional services still quite weak, so the 3-month average for job creation is now only 35,000.
Okay, and we need much more than that just to keep up.
Yeah, you generally need something like 80,000 to 100,000 just to keep pace with population growth. The report even suggests that if you adjust for potential overstatements from the BLS's birth-death model, that model they use for new businesses.
Oh, the econometric model.
Actual job creation might already be negative.
That's a stark outlook.
Yeah.
So for the average person listening, what does this weakening mean? Job security, wages.
Well, a critical takeaway here is unemployment ticking up. It's at 4.25%, and participation, people in the labor force, slipped to 62.22%. With joblessness staying above its 2-year average since way back in September 2023, the report is flagging, rising recession risks. It's a pretty clear signal of a softening job market that can directly hit job security, limit wage growth for a lot of people.
Okay, so shifting from jobs, let's talk about spending. Retail. Headlines might be shouting, summer spree, but this report suggests maybe more of a sugar high. I mean, Americans did spend more in July, nominally. Retail sales up 0.5%, especially cars, gadgets, online stuff.
That's correct, yeah. Nominally, the gains look strong. Cars, e-commerce, they did well. But, and this is key, when you adjust those numbers for inflation.
The real picture.
Exactly. Real retail spending is actually still below its peak from April 2022, and it's below last December's level, too. Historically, real retail spending tends to peak around the same time as highs in the S&P 500 to oil ratio. That's a kind of market health indicator.
And what's that ratio doing?
Well, that ratio often slips below its 7-year average before recessions hit. And these indicators, they're flashing caution right now, even if the stock market seems, buoyant. It hints that maybe some of that quote-unquote extra spending is just us paying more for the same amount of stuff, or maybe even less. #tag the inflationary roller coaster and consumer burden.
Right. Spending more, getting less. That brings us straight to inflation, doesn't it? The report flat out declares 2% inflation. A fantasy. Can you break that down?
Yeah, the report really emphasizes how July's CPI data, the Consumer Price Index, it basically confirmed that the little dip we saw in March, that deflationary trend, it was just a mirage. The Macro Butler calls it the Trump reflation train. Basically, these ongoing inflationary pressures from stimulus, supply chains, tariffs.
Right, the policies from that period.
That train has already left the station, according to the report. Inflation is just stuck, sticky around 3.4% year over year. Tariffs keep adding fuel. So while, policymakers might hope for 2%, the reality is business margins are getting squeezed. And who pays? Consumers. We foot the bill.
So that 2% target isn't just hard to hit. It's pretty much a pipe dream for now.
Exactly. I mean, think about it. To get to 2% by the end of the year, you'd need negative CPI prints for months. Statistically, that's just not happening. If inflation just runs at, say, a modest 0.2% a month, we could be looking at 3.4% to even 5.0% by December. And this raises a really important point. With inflation staying this persistent, there's very little justification for the Fed to cut rates.
Right.
In fact, the report suggests a rate hike before year-end is looking more likely than the market wants to admit right now.
Oof. Okay, that's tough. And this isn't just hitting us at the checkout, right? It starts earlier with businesses. The report mentions wholesale costs soar. Consumers pick up the tab later.
That's a perfect summary. In July, the Producer Price Index, PPI, which measures wholesale inflation, it saw its biggest jump in 3 years, leapt 0.9%. The report has this great analogy. It's like wholesale costs are auditioning for dancing with the tariffs.
Oh, okay.
It means higher import costs are spreading. Exporting countries are kind of sharing the burden by hiking their prices. Services costs up 1.1%. Wholesalers even boosted margins 2% on machinery.
So corporate America is essentially passing the buck, saying you pay for it.
Pretty much, yeah. For stock market investors, the takeaway is, well, kind of obvious. Companies will likely have to keep passing these rising costs straight to us, the consumers. They need to preserve their profit margins, protect earnings. Otherwise, their shareholders end up footing the tariff bill. And that spread between core CPI and core PPI, stripping out food and energy.
Yeah.
It slipped back into negative territory in July, the deepest it's been since last February. That basically shows companies aren't efficiently passing costs on yet. But one way or another, the report says consumers will end up shouldering it. #tag debt piles higher and fiscal fragility.
Speaking of shouldering bills,
Yeah?
let's talk debt. Seems like it's piling up everywhere. The report's headline is stark. Debt piles higher as household balance sheets stretch thin.
Yeah, and connecting this to the bigger picture, U.S. household debt just jumped by another $185 billion. Just in the last quarter.
$185 billion.
Billion, yeah. Pushing total balances to a new record, $18.39 trillion.
Trillion, wow.
It really highlights the increasing financial strain on consumers right now.
What's driving that huge increase? Is it mostly mortgages again?
Housing was the biggest chunk, yeah. Mortgages up $149 billion. HLOCs, those home equity lines, added $9 billion. But non-housing debt also saw broad increases. Credit cards climbed $27 billion, auto loans up $13 billion, student loans $7 billion. And get this, new car loans hit $188 billion. Lenders also expanded credit card limits by $78 billion, HLOC limits by $18 billion.
So people are borrowing more across the board.
The data strongly suggests households are really relying more and more on leverage, on borrowing, just to maintain their spending levels. That's a trend that, might not be sustainable if incomes don't keep up.
And you mentioned student loans. The report calls those out specifically, right? A ticking time bomb.
Absolutely. Since the federal payment freeze ended, delinquency rates on student loans just surged. We're talking serious delinquencies, like 90 days or more past due. They reached 12.9%. That's the highest level in 21 years.
21.
Yeah. It just underscores the mounting pressure, especially with high interest rates and, as we discussed, a weaker job market. And at the same time, bankruptcies are rising. 131,000 consumers filed for bankruptcy in Q2. As these student loan problems move from delinquency to actual default, the whole student debt crisis is probably going to become much more visible, much more impactful.
It's a lot of individual pain.
Yeah.
But it's not just people, right? The government's finances are also looking shaky. The report calls it a deficit disaster, says even tariffs can't fix it.
This really brings up that huge question of fiscal sustainability. I mean, yes, tariffs brought in over $20 billion a month, even led to a rare surplus in June.
Right, I remember that.
But July just wiped that out. Government spending surged, up 9.7% year over year to $630 billion. Revenues, only up 2.5% to $338 billion. And crucially, nearly $20 billion of that revenue was just from tariffs. So if you take those out...
Receipts actually went down.
Receipts actually declined,
Yeah,
exactly.
yeah. So what's the bottom line for the deficit then?
The result was a $291 billion deficit just for July. That's up 20% from last year, the second biggest July gap ever. Year to date, the deficit hit an incredible $1.629 trillion.
Already, wow.
Making 2025 already the third worst fiscal year in history. And interest payments, this is stunning, topped $91.9 billion just for the month. The 10-month total for interest payments is now over $1 trillion.
Just on interest.
Just interest. It now costs more than defense, more than income security programs, more than health spending. Only Social Security costs more. The report puts it very starkly. America's fastest growing sector is now just servicing its debt. A clear reminder of fiscal fragility. #, the Fed's dilemma and global shifts.
Okay, so let's recap. Weak jobs, sticky inflation, soaring debt everywhere, huge deficit. What is the Federal Reserve supposed to do with all this? There's talk about rate cuts, but the report says rate cuts, the beginning of weaker returns.
Well, at the Jackson Hole meeting recently, the Fed chair did acknowledge cuts might be coming, but, kept it cautious. Concerns about inflation from tariffs, the fragile job market, they're still worried. July's weak jobs data definitely helped the doves, the ones arguing for lower rates.
Right.
But the Fed's still divided. And connecting this back, the report makes a strong historical point. Rate cuts often signal underlying economic weakness, not strength. They often line up with muted or even negative stock market returns.
So cuts aren't automatically good news for investors.
Not always, no. And sector performance patterns also tend to shift. When cuts start, energy producers often do better. Think energy sector stocks, the Dow Jones. Better than energy consumers, like the tech sector, the NASDAQ 100. What's really striking, though, is the report uses the Taylor rule, that formula suggesting where rates should be.
Yeah.
And based on current inflation, core PCE at 2.8% and unemployment 4.2%, it argues the Fed funds rate should be around 5.99%, not the current 4.50%.
Way higher than it is now.
Way higher. So even though the Fed's own projections, their dot plots, still point to 2 rate cuts, the reality might be less comfortable. The report suggests as the U.S. possibly shifts from this inflationary boom towards an inflationary bust, the Fed might actually be forced to raise rates, not cut them.
Okay, that is a plot twist. Wow. But hang on, what about this liquidity Fed put? What is that and why does it matter?
All right, this gets into how the Fed might react if markets get really stressed. Shadow liquidity, basically the available cash sloshing around the financial system that keeps things smooth.
Okay.
It's tightening up again. This is partly because the Treasury is refilling its bank account, the TGA, and also because less cash is being parked in the Fed's reverse repo program. With relatively low balances in both the TGA, $590 billion, and the RRP, $77 billion, the Fed might soon feel pressure to, well, turn the liquidity taps back on. So if market volatility spikes, the odds increase that this liquidity Fed put gets triggered, meaning the Fed steps in, injects cash to stabilize things, maybe heading into Q4.
Got it. So like a safety net, but for market liquidity. Sounds like the U.S. economy is walking a tightrope here. But let's zoom out globally. The report talks about something huge. BRICS ditches treasuries. China's gold yuan play for global influence. Tell us about that.
It is huge. Basically, as holding U.S. dollar assets started to look like more of a geopolitical risk for some countries.
Right.
The BRICS nations, Brazil, Russia, India, China, South Africa, and now the expanded BRICS Plus group, they sped up selling their U.S. Treasury bonds. China, especially, is doing something interesting, quietly shifting its domestic economy towards gold-backed savings, while also pushing its currency, the yuan, for international trade. It creates this sort of dual system, a stable home base anchored partly to gold, and a yuan-based engine for foreign trade.
So they're actively building an alternative system to the U.S. dollar's dominance.
Precisely. They're encouraging BRICS members to trade more in yuan, or their own currencies, using gold as a kind of hedge against currency losing value. Some people are calling this setup Bretton Woods 3, comparing it to the post-WWII system. But this version has decentralized gold storage, flexible pricing. Countries can choose to peg to gold or the yuan or their own currency. The idea is it incentivizes industrial growth, economic independence, with China positioned as a key partner for infrastructure and trade. And U.S. treasuries, they get increasingly sidelined in this new landscape.
And tied to that, the report mentions a gold makeover courtesy of BRICS. What's that about?
Yes. It's about how these BRICS Plus nations are diversifying away from the dollar, playing to their strengths. Since 2022, their central banks have been buying gold like crazy. They now hold over 20% of all global gold reserves. Just in Q2 of 2025, their purchases jumped 41%. Russia and China lead the way, holding almost 3/4 of the bloc's total gold. And with over 10 new members joining this year, BRICS Plus is really reshaping global finance towards a more multipolar world, trading less in dollars. Geopolitical tensions, this diversification push, it's all helped drive gold prices to record highs, and it helps that BRICS members also control huge gold deposits themselves, boosting their financial independence.
Okay, so bringing it all together. Weak labor, sticky inflation, all this debt, these global shifts. The report asks, the U.S. is still in an inflationary boom, but for how long? What's the verdict?
Well, as of mid-August 2025, the report says the U.S. is technically still in that inflationary boom quadrant. It's been there since May 2023. In that phase, typically, owning equities and gold has worked well for investors. However, and this is a big however, that S&P 500 to gold ratio we mentioned, it broke below its 7-year moving average back at the end of January.
And you said earlier that's historically not a good sign, right?
Never a good sign, according to the report's historical analysis. Every time that ratio broke down, early 70s, early 2000s, January 2020, it signaled trouble ahead. And that breakdown usually precedes, by a few months, a similar breakdown in the S&P 500 to oil price ratio,
Okay.
which has also never been a good omen for markets or the economy. It tends to signal that shift into what the report calls an economic bust.
So if we are heading into that inflationary bust, maybe stagflation, what does it mean for investors listening right now? What's the strategy?
This really raises the crucial question of portfolio positioning. The report advises that once that S&P 500 to oil ratio also drops below its 7-year average, every stock market rally should be seen more as a selling opportunity.
Sell the rips, basically.
Kinda, yeah. At that point, the focus should shift. Buying dips in energy producers while selling strength in energy consumers. And the emphasis throughout remains on quality companies. You want businesses with low debt, low refinancing risk, and high return on equity, ROE. Those are the ones that can potentially grow earnings and cash flow faster than inflation.
And what about gold? The report had that strong line, gold is for war.
Exactly. It means physical gold and silver are seen as the key assets for navigating this potential inflationary bust, or stagflation. History suggests gold performs well in times of turmoil, hence, gold is for war. In this kind of environment, the report strongly advises avoiding long-dated bonds, especially government bonds. They tend to do poorly with sticky inflation and volatile rates. Instead, gold, silver, other hard assets with limited supply, think platinum, oil, base metals, agricultural commodities, those are positioned as the anti-fragile risk management tools, not government bonds, as the economy potentially moves from boom to bust. Hashtag, outro repeller.
Phew. Okay, that was an incredibly detailed deep dive into the month that it was, August 2025, from the Macro Butler. We've definitely seen a complex, maybe concerning picture emerge. An economy facing pretty significant headwinds, weakening labor, stubborn inflation, record debt loads for households and the government, plus these huge global shifts.
Indeed. Yeah, while the U.S. might still be technically in that inflationary boom phase for now, the cracks are certainly showing. They're becoming more visible. The signals from those key ratios like S&P 500 to gold and the tough spot the Fed seems to be in, cut, hold, maybe even hike, it all points to a really complex, uncertain period ahead.
Absolutely. That narrative of getting back to 2% inflation feels, well, like a distant dream right now. Consumers, corporations, they're all grappling with rising costs, stretched balance sheets. It seems clear, as the report suggests, that the 2020s could start looking more like that 1970s lost decade for passive investors, unless we see some really significant changes. So maybe here's a final provocative thought for you, our listener, to ponder. In this world where global financial power is clearly shifting and our traditional economic dashboard is flashing all sorts of conflicting signals, how might the everyday choices you make, what you buy, how you save, how you invest, need to adapt to navigate this evolving landscape and build your own financial resilience? Thank you so much for joining us on this deep dive. Until next time, keep digging for those insights.